So our next presenter, Paul Clark from CanCambria Energy. I think I put in the write-up. You know, we've written. We do energy companies occasionally, and this one's kind of unique. I think happens to be in a spot of the world that I think is going to probably scrambling around looking for energy here shortly. We already are, but I think that's going to become more acute. And I think recognize this is a really big project. I mean, it's more substantial than a lot of them maybe that we're used to seeing in this forum. So I think keep that in mind. But again, we've kind of had a couple of these stories over the years of oil and gas projects in other parts of the world. The ones that I've done so far have worked out really well. So I sort of like follow it around and see what it needs. So.
Thanks, David. Appreciate the introduction. Yeah, pleasure to be here. I'm Paul Clark, President and CEO of CanCambria. First time presenting at this forum, so really pleased to be here and share our vision for natural gas development in the heart of Europe. The image up on the screen there is Budapest. We are a Canadian company, but our entire asset base is in Central Europe. If you ever have the opportunity to head to that part of the world, I highly recommend it. It's a great place culturally, great city to visit for a long weekend. So we're relatively new to the market. We listed about a year ago on the Toronto Exchange, or the Toronto Venture Exchange. More recently, we're on the OTC. We have a Frankfurt listing, logically since the asset is in Europe, and European investors are a little more sensitive to the energy supply landscape in Europe. Forward-looking statement. Specifically, I'll talk about resource numbers and some valuations associated with that. Those numbers come from an independent audited source, but again, they are forward-looking statements. So to give you an overview, we are an exploration and production company. We're really towards the end of the exploration phase. We do not have any production right now, so zero revenue coming through the door. We're in growth mode, appraisal mode, hoping to drill our first series of wells towards the middle and second half of next year. We entered Hungary in 2022. I joined the company specifically to work on this asset. We had a 5-year plan. We had a 5-year plan to get a acreage position, a consolidated acreage position. We've now done that. We have a little over 1,000 square kilometers, so a really significant footprint in Hungary. We wanted to establish over that 5-year period a credible source of resource numbers. We're in a mature basin. There were a lot of legacy wells, 3 wells in particular that are important to the story. They produced oil and gas to the surface, but we did need to invest around $4 million in a new proprietary 3D seismic survey, and I'll show you the results of that survey here shortly. That really dials into this 500 BCF of risk recoverable resource that we have. In addition, 50 million barrels. So it's a wet gas condensate type of play, and the valuation using current pricing is well north of 1.5 billion. Again, these are risk contingent resources. These are not proved reserves. There aren't many places in Europe that you can come in as a brand new company and establish such a footprint over a relatively short period of time. We're around 3 years in, so by year 5 we're hoping to have wells drilled and have production on stream. We are in a fairly critical part of the venture right now. We're in the middle of a joint venture process. This is a capital-intensive project, as you will see. These tight gas wells are relatively expensive, and so we're looking for a partner. We have a process underway, and I'll speak to that also. I think David introduced this. We are in the middle of, I say, an energy crisis in Europe. Crisis kind of suggests it's short-lived. It's far from that. There's a big supply side issue in Europe in terms of largely natural gas. The chart you see on the slide is also repeated in the books that you have, so I don't need to spend too much time reviewing that. We did a direct listing about a year ago, so we didn't raise any money when we went public. We were in the data evaluation stage at that point. The cap structure on the right-hand side of my slide here illustrates a relatively clean share structure. 10% insiders, no doubt on the balance sheet. The original investors are still very much involved in the project. We have around 55 to 60% held with Hayward Securities, their high net worth friends and family that originally funded the company. We've raised through that network around 8 million Canadian this year. We plan to raise a smaller amount between now and the end of the year to see the company through this joint venture process. I don't have time to go through all the list of key contributors here. I will tell you we've got an office in Budapest. Pete Van Ash, former Shell, runs that office for me. I spend my time between North America and the UK. My background is I'm a petroleum geologist. As I said, I joined this asset specifically, the company specifically for this asset. My background, I spent 15 years with Pioneer Natural Resources working in Eagle Ford and Permian Basin. We took the Eagle Ford, we drilled over 100 wells, took the company from $40 a share to $100 a share, and then with the Permian Basin, took the company from 100 to 200, and then the Pioneer was bought out by Exxon last year for $60 billion. So that's the power of organic growth, having a large land position and being able to grow that position organically. The nice thing about these tight gas and unconventional resources, they are self-funding within relatively short order once you get through that funding gap of the initial 2 to 3 years. Prior to joining CanCambria, I did spend 3 years just up the road here with Ultra Petroleum. Inverness Drive was the office near the golf course there. And I worked at giant Jonah Pinedale Anticline, largest natural gas producer in the state of Wyoming. And that field is very analogous to a lot of what we are trying to accomplish in Hungary, both in the subsurface, the reservoir, but also operationally. The biggest accomplishment that Ultra had in that field was controlling costs and bringing wells on much more quickly. They originally were drilling wells over about a 6-week period, and they got wells down to 2 to 3 weeks. Okay, so let's talk a little bit about the natural gas landscape in Europe. We could probably spend the rest of the presentation just on this topic. Natural gas trades at a 250% premium to North American, even higher when you compare it to Canadian natural gas. On a US equivalent basis, natural gas is trading for around $10 to $11, which makes a huge impact to the economics of these projects. As I mentioned, most of that is supply side. You can see from the graphic that kind of the catalyst for what we're doing, the catalyst was really the Ukraine-Russia conflict where prices skyrocketed. Lots of measures put in place to combat those really crazy high prices. You know, our project is economic down to $4 gas. So we see outlook of $9 to $10 in the summer, $10 to $14 through the winter. In Europe, the gas is traded at a benchmark European exchange. So we don't see that natural gas price changing really anytime soon. A lack of investment really broadly across Europe. A lot of the larger fields are on natural decline, limited investment. Many countries like the UK just are very pro-decarbonisation and just not really interested in investing in oil and gas ventures. Hungary itself imports around 70% of its natural gas from Russia. They're trying to, of course, for a number of different reasons, come off Russian gas. They get a modest amount of natural gas from Azerbaijan. Viktor Orban and Donald Trump were visiting earlier this week trying to figure out sanctions, etc. So again, there's a lot of political rhetoric around energy in Europe. Bottom line is the supply side is really challenged. The base price is really going to be dictated by LNG going forward. So we see a huge opportunity in that natural gas space if you can establish a footprint within Europe and you can get a project online. Surprisingly few companies in Hungary that can address this energy deficit. The chart on the left-hand side illustrates the main companies. By far and away, the largest company is MOL Group, formerly state-owned. They're free trading on the Budapest exchange, and they dominate the market. The histogram here is actual resource base. I did resource base rather than production so that I could illustrate CanCambria's audited resource numbers shown in the gold on the right-hand side of that plot. The reason for showing that is we can be a significant player in country once we get this project up and running. Some of the other companies that are in the space there, Aspect Energy, you may know, is a Denver-based private company. Vermilion is a Canadian public company. NVM is a utility company in the country. They just signed an LNG agreement with Shell. They bring in the gas product from Azerbaijan. There's a testament that there's just not much investment. Gas in Hungary is deep, it's hot, it's high temperature, high pressure, and it's expensive to get out. So MOL have done a good job with shallow conventional oil, but really nobody's addressing the gas issue. To that end, the government there, the ministry, very supportive. They have probably the best fiscal terms I've ever seen for an oil and gas project anywhere in the world. We get an NRI of 98%, meaning the government takes just 2% of the product that we produce. And you can imagine 98% NRI and high commodity prices really makes the economics fly as a really economic project. In terms of the location of our asset, the inset map shows the footprint of our land position. It's about 2 hours south of Budapest, quite close to the Serbian border, and a large contiguous position. I'll zoom in on the next slide to that acreage position. What I will say is we have excellent trunk line facilities for pipelines. We don't have any significant build out of any infrastructure at the present time to hook the initial 3 wells that we plan to drill. Relatively short, less than a kilometre tie into a gas storage facility. This part of the country is dominated by 1960s, 1970s vintage oil and gas prospects. So there's good infrastructure. There are also quite good services in the region too. The small triangle inset on the right-hand side of this map here, the small triangle that has the red star, that's the block we picked up in early 2023. It's around 30,000 acres. We're drilling our first well approximately as shown. That is the majority of the asset that we have valuations for, that we have audited numbers for. We actually picked up that much larger block earlier this year. And that, for context, that area is around the size of Denver County. It's almost 250,000 acres. So we put this position together for less than $6 an acre. So a relatively low cost entry. There's not many places that you could go. And this is a proven basin. Plenty of oil and gas produced from this part of the world. We didn't really want this large position, but we had to pick this block up through competitive tender. We outbid a couple of larger companies to get it. It brought with it, or brings with it, a basin to the north that has some prospectivity. We look to shoot 3D there maybe next year or the year after. And also a number of shallow oil and gas fields that have some, albeit more modest, potential, nevertheless some shallow oil potential that we'll look to develop. The small table in the lower part of the graph here indicates the drill rate for this area over the past 50 years or so, and the obvious takeaway is since Hungary became independent, there's been really no investment into the area. So we picked up a big, large area in a proven petroleum basin with almost no drilling activity over the last 30 years at almost no cost. So, it's a pretty big win for the company. The one thing we did need to invest in to make this drillable and make this investable was a large-scale 3D seismic project. This technology really didn't exist to a company of our size 7 to 10 years ago. The wireless node technology, the way that we acquired and processed the data, was probably not even affordable to CanCambria 5 or 6 years ago. So there's been some step changes in that regard that allowed us to do some complex imaging of this deep reservoir. And that imaging was really essential to de-risk the drilling locations. We've got around 50 or so drilling locations, 3 permitted wells to go drill, and the 3D seismic was really instrumental in de-risking the project for us. This is a cartoon. I mean, the 3 wells that were drilled into the field, two produced hydrocarbons to surface. 1 drilled in the 80s. Once they tested it and ascertained it was tight, low permeability, they walked away. The more recent well, the last well in fact drilled in the field, was in 2008. It was fracked in 2011. It was fracked in 1 stage, a modest 2-meter thick sand. It was drilled really on the edge of the prospective fairway. That well tested 3 million a day for 6 months. It declined quite substantially, as a tight reservoir often will, and they sold gas into the storage facility quite close by. So we had 2 wells that tested gas. What they didn't have was any way ahead of the drill bit to figure out where the sweet spots within the field were located. The map I'm showing you here is one of the products of our 3D seismic workflows. we were able not only to image the structure, the faults, the layers, but also the rock quality, the porosity, and by proxy, some assessment of fluid saturations within the reservoir. So that gives us really a fairly high degree of confidence as we where we should drill. That really translates into the resource numbers that I'm showing you on this slide. These are what we call contingent resources, meaning we know the oil and gas is in the ground. We just don't have at this present time any demonstrated commercial production. So that's the challenge of the company, is to get these resources produced to service at commercial rates and volumes. The petrophysical data, the logs, the core, all the tools that we have to make the accurate assessment of what oil and gas is in the ground. We started with about 2 TCF for that focus area. When I went to my investors and the board and told them we wanted 3D, they asked me how much larger the accumulation was going to get once we'd acquired the 3D seismic. And they weren't happy when I told them it would probably get smaller. But what it did do, it gave us a huge amount more confidence on where we should be. So at the end of this initial seismic program, we have about a 4,000 acre focus area, and that 4,000 acres gives us around 502 BCF of risk recoverable resource. The auditors wanted to give me 100 drilling locations on 40 acres. I said I'm happy to take 50. You know, we want to be fairly conservative with that. Even with 50 drilling locations, using $10 gas, $65 oil, the valuation of those 50 wells is somewhere north of $1 billion US. So a significant valuation. Now that is a capital intensive project. What that looks like in terms of development is parking a rig in the field for basically 10 years, drilling 6 wells each year. So a very sizable investment. That's really where understanding the energy landscape in that part of the world, who would be best suited to long-term develop an asset like this? Probably not CanCambria. So we want to get in, prove up the resource, demonstrate commerciality, understand and define what the economics look like, downspace potentially, cost savings, etc. And then maybe in 5 to 6 years' time, we'll move it on to an operator that will lead it for the long haul. There's a lot more acreage to go assess. This is just the first drill-ready prospect that we have. In terms of timeline, the Gantt chart here, we're in the middle of this joint venture. We engage with a company called Raiffeisen. They're an Austrian investment bank. We have reach with those group through a board advisor. Typically their transactions are several hundred million into the $1 billion type of range. We're looking from this joint venture to bring in somewhere between 40 and 50 million US dollars to drill the first 3 wells in the project area. The funding gap between when the project is presently and when the project is self-funding through cash flow, through operations, is around that 50 million number. So you can anticipate once we get that funding gap figured out, then that stock should move. When we get the first well drilled, the stock should move. We repeat the drilling performance, stock should move. We're talking with all those companies that you saw on that initial slide. We're talking with, we've got NDAs signed, so we hope to get something end of Q1 in terms of getting this project funded. No doubt, it's the market is looking at CanCambria to perform in that regard. We could probably fund the first well ourselves. We don't want to dilute at the corporate level. For me, having done this many times, your first well is not always your best well. So we wanted to have a 3-well program to really get our understanding into the project. The first well is going to be in the region of 18 million US production. Get the prices down maybe to 15 million in the near term, but yeah, certainly a pretty capital intensive program. The cash flow model on the bottom corner there, year 4 you're looking at bringing in on a 100% basis pre joint venture anywhere maybe up to 300 million. It's a cash cow once we get this thing rolling. Tight gas, repeatable, statistical once we get commercial production. Yeah, we're really excited to get this going. So last slide, pulling things together. Very difficult, opportunistic time for us, very difficult to get a land position within Europe. Many places don't let you operate. Hungary is very pro oil and gas. And so we're very fortunate. We were quite lucky and opportunistic, as I said, to put this land position together. Macro conditions are good. supportive government, fiscal terms are good. We have a fairly well-defined program that we think will bring value to the corporation. As I said, we're a really critical part with the funding. And in theory, you could be there 5-10 years drilling in that part of the basin to address these. No, Hungary's never going to be energy independent, absolutely not. But if you can at least address some of the domestic production, that helps the country, helps the government maybe move a little bit away from Russian gas. And probably the most important part is we've done this before. We've done large-scale projects like this in many different basins around the world, and we're not intimidated. So yeah, we're excited what the next 18 months hold, and appreciate your attention, and we'll take any questions.
I have a question. So one of the things that I'm sort of trying to get my arms around is when I read your collateral, how much, I guess the part that scares me a little is when you talk about the deep, hot wells. I mean, is that hard to overcome? I mean, I'm thinking in terms of our sort of unconventional things where we have, horizontal drilling, things can go wrong. I mean, that seems like a challenge, a drilling challenge. I mean, and you sort of address that, and that's where you're going to drill 3 wells instead of 1. But how big a challenge is that in the grand scheme of challenges in the different oil patches?
Yeah, we would never want to underestimate how difficult it is to find oil and gas, but there are two wells drilled within a kilometre radius of the area that we're drilling. Those wells were drilled several decades ago. They were drilled safely. They were drilled as planned. So we know it's a hostile drilling environment, but it was doable then. Technology is certainly doable now. The only thing that they did, it took them 6 months to drill those wells. And we certainly don't want to do that. The timeline for our wells is around 2 months. So that's the technology part. 2 months. Now, the pressure is good for these tight gas systems. We want the pressure because we want that depletion drive system going. A lot like we've done in all these other vertical tight gas systems, Cotton Valley, for example. A lot of the basins in the Rockies, certainly Pinedale is overpressured. So we're not too worried about that. Temperature is a little bit unusual. It means you pay quite a bit more to burn out tools, but it's not something that's insurmountable. You don't need to log every single well. The first 2 wells we'll probably end up spending $1 million to log that first well. We won't do that again. Hopefully not have to do that too many times. But yeah, the goal for us is operational success, drill the well safely, technical success, which we're saying using those seismic data sets, we can pinpoint the sweet spots, and then commercial success, stimulate the well, bring on the reserves. And so we need all those things to align. So we consider it to be low risk. Having talked to a lot of people in Central and Eastern Europe, they have very low tolerance for risk, and so we're looking for investment, internationally, just because the appetite, mindset is just not there for this type of project. As you described, it's respect Mother Nature because it's deep, it's hot, and you need to know what you're doing.
Were the Pinedale wells that deep?
They were deeper, yeah, deeper. Oh. Yeah, they were deeper. And of course, they were horizontal, which makes things even more difficult. But yeah, we don't anticipate too many operational issues. It's really bringing down the costs, which is going to be the game changer. We know the oil and gas is in the ground. Once we commercialize that, then all the attention has to be on bringing those costs down. For example, that type of well that we're talking about costing $15 to $18 million, you drill that here for $3 to $4 million, routine. And so it's just the price of doing business in Europe that maybe we can address over time with our own frac crews, with our own drilling rigs. Once we have a presence, we're not getting very good deals in Europe at the minute because we're CanCambria. Who are you guys? You want to mobilize a rig for 1 or 2 drilling campaigns, that's another $1 million, right, to bring a rig in. Not to scare off investors, but when we see natural gas prices moving even higher towards $14, $15, it's still a cash cow ultimately down the road.
So who are your investors?
So we have 10% insiders, so myself, the executive team. About 60 to 65% of our investors currently, even though we're public, are still Hayward Securities out of Vancouver, high net worth. That group still really believe in the project. They believe in the valuation of the project. They don't want to get out until we've tested that first well. So we've got to get to 50 million, so we're going to sell down at the asset level. The reason to do the resource assessment is to understand, if we're talking a valuation of a couple of $100 million, you really can't shed anything at the asset level. You know, you've got to protect that asset 'cause it's not, you know, it's not that large. You know,
So is
with
it your network of people that's gonna get the 50 million?
So it's Raiffeisen Bank International, they're the investment bank, they've reached out to around 75 potential investors, whether that's a large integrated oil and gas. We're in this niche between, we're too small for someone like Shell, but we're too big for, you know, smaller investors unless you get a consortium together. Plus, being selfish, we wanted a strategic investor that adds credibility to the story, and that also, you know, potentially down the line, you know, would be in it for 5 to 10 years, would potentially be in it for 100% of the interest, you know, in a success case. So there's, you know, we've been fairly selective in terms of who we're talking to, which has taken a little bit longer than we anticipated. But yeah, that's a fair question. That's a fair question. So, you know, the ideal investor will, as I said, underwrite most of the cost of those 3 wells, and they're doing it for a huge amount of upside. I suspect we'll probably need to chip in around 10% per well is my gut feeling on this when it's all said and done.
So does that include the completion too, the 15 to 18 million?
It does. Unlike the US, the completion is not, we're not doing huge fracture stimulation, so 70% of the cost is the drilling and 30 is the frac.
Well, can you talk a little more about the service infrastructure? You mentioned a couple times here.
Yeah, it's pretty good. Romania, you got a lot of crews in the North Sea that are really doing nothing, so you've got all usual suspects. Halliburton's there, Schlumberger's there, MND's the big company. A lot of hot geothermal wells being drilled, so there's experienced crews in country, so yeah, it's pretty straightforward.
Well, significant midstream infrastructure, because it's becoming more, I think, because it sounds to me like a lot of the LNG is going to Turkey, and then the LNG is coming into Turkey and then being distributed through Hungary and other parts of it. So there's certainly a lot of midstream infrastructure.
And we'll probably need to sell the product into the Hungarian system rather than send it. We'll probably get better money sending it south into Serbia, but yeah, there's a lot of infrastructure. We don't need to near-term spend too much money on infrastructure. Everything's there. And a lot of the first wells rental equipment gets us what we need.
You'll be around, right?
I'm around. Yeah,
Great.
appreciate any more questions. Thanks.
Thanks a lot.